Welcome back to the Scholar Wealth Podcast. This week, we're dedicating the full episode to a conversation I had with Brandon Mendez, who joined us at the Scholar Wealth Podcast studio for a conversation about business ownership. Brandon is a professor of finance at the Darla School of Business at the University of South Carolina, where he teaches corporate finance and investments. A U.S. Navy veteran, Brandon built real-world experience in financial services, auditing, and consulting before earning his Ph.D. in finance from Florida State University and moving into academia. His research sits at the intersection of corporate finance, labor markets, and capital allocation. And right now, a big part of that work is focused on how demographic shifts are reshaping private business ownership and what that means for investors. That last piece is exactly what we dig into today. With so many business owners hitting retirement age at the same time, there's a wave of acquisitions happening, and private equity is moving fast. We talk about how to think about multiples and what seller discretionary earnings actually hide, why PE firms have such a structural advantage over individual buyers, how AI is starting to change the talent calculus in acquisitions, and what the red flags look like when you're sitting across from a set of financial statements for the first time. If you've ever thought about buying a business or own one and thinking about what comes next, this one's for you. Today, we're talking with Brandon Mendez, so speaker at our conference for multiple years.
2 years now.
2 years. And so this year's discussion, we were talking about buying businesses and this generational shift in business ownership. So I wanted to continue that with the podcast this week. So Brandon, welcome to the show.
Thanks, Steph. Thanks for having me.
Before we get started, because I know some viewers may know you from the conference and everything else, but give us a little bit of background of what has got you into the business world as opposed to the academic world where you've been as well.
I would say I've always been interested in the business world. That's where I started in my career. So corporate America, controller for a nonprofit, and then going into banking and doing internal audit from there. But what got me back into business inside of academia was I had done some consulting work while I was working on my doctorate and started being a professor at University of South Carolina. And I was like, there's got to be an easier way than doing startups, because that miss rate of 90%, right? 10% succeed, 90% fail. It's like, there's got to be an easier way to do this. And that's when I came across buying businesses as the easier route, maybe arguably so, of getting into business and being successful from there. So just kind of sticking around the business community, talking to a lot of people, and then just trying to find the next avenue.
Is there, because the failure rate is massive. And one of the things we see all the time is when you look at wealth generation over time or ways to generate wealth, business ownership is one of the top ones.
Right.
It's one of the top options, equity and all of these different comparisons. But what is missed in that conversation is the failure rate is massive, right? So, which I'm always a fan of. Anytime we have the balance of the risk and reward aspect, and business ownership is definitely in that range.
Yes.
When do you see that fall, where that success rate starts to? Is it the first year? Is it 3 years? Is there a number point of at a certain revenue level you start to see that get shaky?
As far as the startup goes?
Yeah, just if you're saying, if we're trying to mitigate the risk of that 90% failure rate, and we're mitigating that risk by buying a business as opposed to having to start one from fresh, at what point does that risk curve start to shift where you say, now they've gotten past point X, which means their failure rate is lower, sufficient for me to be able to invest?
I think the curve starts to tick up for survival after year 2, but it's still fairly steep when you get to year 5. So obviously revenue helps if you can start generating revenue if you're a startup. But from there, if you can make it past year 5, you generally have a somewhat sustainable business from a traditional startup perspective. So I'm not talking about Amazon reselling businesses. I'm not talking about websites or blogs or stuff like that. If you're just trying to do a traditional startup, either they're in the tech space, manufacturing space, or something like that, you can get past year 5, you're generally in the safe area.
Do you think that's because at that point, it's no longer, I'm glad you brought up like the Amazon reseller businesses and everything, because you have this whole, like everyone's got their own business, but really what they have is a job. Right? They've purchased a job and a very low paying job from a numbers perspective, right? On a per hourly perspective, but it's still constrained to just them. And then they move to this whole area where at year 5, right, especially if you're in any of these areas, tech, manufacturing, everything, there's a team that's being built around it.
Right.
Is that the reason why you have more sustainability? Basically, year 1, you have the big risk of, does the idea even work?
Right.
But then from year 1 to year 5, there's plenty of businesses that we know of, and especially like we're talking consulting type businesses where somebody is solo and they still have a successful business and they have this successful kind of one person business that can last for a very long time and
Right.
be successful. But at year 5, now if you're growing, you're having to deal with other problems besides the idea
Yes.
situation.
Yes.
So do you think that is the factor there, or what makes year 5 different than year 1?
I think it depends based by business type. So in the consulting space, that's where I was. We had a friend of mine started a consulting business, and he had one contract to sub out for KPMG. Right, they had a team already, and I joined the team,
Yeah.
and that one contract was great, and it had revenue for sure, but it had the risk of, well, you only have one contract, and if that contract gets canceled or ends, like, you don't have a business anymore. So the idea from there, from the consulting space, is you need to get more contracts, and each contract has its term to it, a year, 5 years, whatever it is. So that was in that space, how you would scale from there. I think the Amazon reseller space is a little bit different. So there was the boom leading up to COVID. There was like a kind of a post COVID boom. But what you saw was a massive amount of competition start to trickle into the reseller space, and a lot of businesses that got stood up. And then I was like, hey, I stood up a job for myself,
Yep.
but I can sell this in 12 to 18 months as long as I get revenue and can say we'll call it air quotes sustainable.
Yeah. There's some semblance of recurring.
Yes. Like 12 to 18 months of revenue, though, it's like, are they really doing that well? But they got enough to say, like, okay, I can put together a set of financial statements and I can try and sell this business on to the next person that wants to buy it. So you saw like a boom in 21 to 23, I think, of the Amazon reseller businesses coming out. Hey, I've been around for 2, maybe 3 years, or even 18 months. Those where people created a job for themselves, decent amount of revenue, and sold it on to the next person. Whether
Yep.
it was actually sustainable, I don't think has worked out very well, but there are consultants in the Amazon reseller space that will look at your business, your Amazon business, and say, hey, this is worth buying or it's not worth buying. So it's all situationally dependent.
Yeah, and that's one of the things. So, I mean, I'm thinking back on the Amazon reseller thing. It was a wave kind of right after I got through my websites and selling websites and all of this kind of. You
Right.
had like the niche site craze of the like early 2000s that was in that area of just putting content out on the internet.
Yes.
And as long as you had a unique topic to put content out on, then you could go. But the EBITDAs on that, like the multiples, it was essentially like maybe 1 year revenue, and that was it.
That was it.
And they're essentially buying the recurring nature of this business will last throughout 1 year, and
Yes.
then it go. But that doesn't necessarily change too much on some of these other
Right.
businesses, which is really interesting. That I want to ask you a little bit about the multiples that you're seeing. We're seeing this big wave of businesses being sold that have been around for a
Yes.
long time, but they're running the same issues of multiples still being around, assuming a non-fast growing business or anything. Kind of think of the retiree manufacturing business
Right.
that's there and it's kind of trucking along at GDP growth rates. And maybe they're selling for multiple of 1 to 3 times revenue,
Right.
right? Does that seem in the range that you're seeing right now? And then if so, is that part of the reason you're saying of that's a lot safer of a bet? If I can pay 1 times revenue for something that's been around for 30 years compared to 1 times revenue for something that's been around for 12 months,
Right.
that seems like a no-brainer to shift toward that area.
Yeah. I think the multiples, so what I've seen from this, and I would say I'm still somewhat new to it. I've been looking at it for 3 to 4 years now. Um, but it's 1 to 3. It depends on what your top line revenue is and like what you're doing. So
Yep.
like a SaaS company, a software as a service company, a little bit different. AI is pushing on them right now, and
Yeah,
everybody says
sure.
SaaS is dead, but I tend to disagree with that depending on the space it's in. Manufacturing, landscaping, it just depends on the business type. So in those spaces, it's what top line is. If you're at 1 million, I think it's like 1 to 3, usually about 1.5, because who wants to sell a company at 1x their revenue or 1x their EBITDA? As you scale, though, what pushes the multiple is as you scale, if you get your EBITDA from, let's say, $150,000 as a $1 million top line revenue company, right? That's not a lot of margin of safety.
Yeah.
Like, and one, if you're going to pay yourself that as a salary, that
I was just about
150,000
to say
is
that's
your
the worry that
salary.
always comes up, right?
It's like, yeah, that's your salary, because really that's your take home. Like, we call it seller discretionary earnings, but you're risking whatever it is you giving up to buy this business, and maybe you're going to make 150. Like, you hope to make $150,000. Outside of that, it's like, okay, can I keep the business and sustain it and then grow it? So maybe the person that's running the business, let's say you own this business right now, you're making 150 and you sell it to me and I'm paying, let's say 1 or 1.5x
Yeah.
on this. Okay. I hope I can make 150. Like I'm probably optimistic
And you're going to work for it.
and I'm going to
So,
work for it. So like I'm going to put all this time in buying the business, risk my capital or investor capital, whatever it is. Let's say I don't make 150. Let's say I make 100, right? It's kind of tough pill to swallow. Like I just lost a good chunk of my what I thought I was going to take home. What if you make zero at that point? So like your margin of safety from zero is only 150, and that's all supposed to go to your pocket anyway. So as you push up out of that range and you get to like let's say a $5 million top line company that's bringing in 800,000 bottom line. Where you see the multiples push up is one, you have more revenue. It should be fairly safe at that point. It's not a given that it's going to be fairly safe, but you get the competition of it's now 800,000 in bottom line, and I can now compete. Like, if I lose it down to 500, it's still good,
yeah.
right? It's probably not going to go to zero, but it goes down to 500. I'm still doing better than the 150. So that's where you see
And
competition.
operator cost as well, right? If you need to go replace your role,
Absolutely.
800 gives you a little bit of cushion to be able
Yes.
to.
If you ever looked at business listings, have you ever taken a look at it?
Oh, yeah. Yeah.
If you see the ones that are like let's say a laundromat, right? 150,000 in seller discretionary earnings. What you don't see is that the person that owns the laundromat is there day in and day out, or having to show up, I don't know, 20 hours a week to collect coins on the machine or repair the machine. It's like, okay, if you don't live in that area and you buy the business, you have to put someone in. Or if you don't want to actually run the business yourself, you have to put a manager in place and you need to cut your earnings down to pay that person.
And that's where, so that's a good example, the laundromat example. So so if you're going in, let's say I own a laundromat and I'm going 20 hours a week and they're collecting coins from the laundromat. It's really difficult for me to go hire somebody
Right.
whose only job is just for 20 hours a week. They're going to go collect coins
Yes.
and clean up the laundromat. It'd be a lot easier for roughly the same amount of payroll for me to have two laundromats and for that same person to be able to go now to two and have the scale
Absolutely.
that way. But the problem ends up being I still have to find a good person to run
Yes.
now all of the laundromats.
You're hitting on the point that I was thinking of. Am I going to hire somebody, right? Just put out an ad and hire somebody to go pick up cash, not checks that
That's
are made
true.
out to
That's
my
another
business.
factor.
I'm going to go pick up cash and like
Yeah.
report 100% of that cash back to me. There's a lot of trust in that person to do it. And if your revenue isn't, or your bottom line isn't that big anyway, how much are you going to take off of that?
Yeah, they're usually collecting a bonus every couple of days
Right.
in quarters.
It's like you skim 5%. Will you notice it as the owner?
Yeah.
It's funny. I have a buddy of mine from high school, family down in South Florida, and one of his cousins bought a laundromat. But what came along with it is he had to go clean out the coins out of the machine. So he pulls up in his Tesla and he uses his Tesla charging cable bag as his like sack to collect all these coins. And like once a week, he can't take vacation too much because he has to go collect all the coins out of the machine because he didn't have anybody else to pawn it off on.
That's a mess. And that's where I see this big disconnect happening. If somebody comes in and says, well, I'm going to start buying businesses because I think that'd be a lot of fun. Because it's fun. That's an exciting thing. Like,
It is.
There's a
Bought a
part
business.
that, yeah, exactly.
Sounds
Buy a
good.
business, especially you could grow it. You have some sort of skill set that comes in beforehand from whatever job you're at. We see this a lot with managers who've done a really good job, whether they've owned a business before or have run businesses for a larger corporation. And they say, this is my shot. I don't need to make the money anymore. So I can go buy the laundromat, and the problems are the same types of problems, but they're much narrower. Right? You're still dealing with processes and operations, but not for $1 billion business. You're doing this for a $150,000 business, so you still get to play a little bit in the war. It's like playing Monopoly, right? You get a chance to play Monopoly with this business, and you get to tweak some things, and maybe you buy an ad, and you do all of these factors, but it always comes to the exact same bottleneck of they're still going to have to be the one running it.
Yes.
Right? And they start to scale. So you have this good idea, but then they end up buying a job. But then the other side of that is private equity is all over the place right now.
Right.
It's unreal. And I don't know if you have updated numbers on any of that, but the number of businesses being bought out by private equity, I see it all the time. Is these mom and pop businesses that have been run forever that maybe don't want to sell or have thought about selling or maybe have handed the money on to kids, but now private equity comes in and says, all we do is buy laundromats.
Right.
And we're going to buy yours.
Yes.
And how? How does that shift happen from both the private equity side and why it's a good time now for private equity to be in that space?
So I'll go back to one thing before we hit on private equity, because private equity conversation is a pretty decent conversation, a decently long conversation. So the laundromat is a certain type of problem. If you're going to go from I work in management at a manufacturing company to
Yep.
now I bought a business and it's a laundromat, right? You're dealing with laundromat problems, right? So if you think about the Monopoly board, you're not dealing with Park Place,
Yeah,
right?
exactly. You're stuck on Connecticut Avenue.
Yes.
Yeah.
If you ever talk to business owners, people that have done this or own businesses, what they'll tell you is whatever type of businesses you have, like who the clientele is, are the types of problems you have. So you could have lower end problems that would come along with a laundromat, or you could buy an audiovisual company that only does audiovisual systems in homes that are $2 million and up. And you have a much different problem and different clientele base that go along with it. So what you buy is situationally dependent on the problems you're going to see with it, right? And the demands your client's going to have on you. The private equity conversation, that one gets into competition, right? I think like every month now, you see a new private equity shop is springing up,
Yep.
whether it is full blown private equity where they've raised a fund or it's a family office. So what they have to do, there's only so many businesses for sale, especially if you look geographically, right? We want to buy a business in Winston-Salem, North Carolina. What kind of businesses can we buy? Right. So maybe I want to buy a $10 million top line business, revenue business. Okay. There's not that many there. I'm going to push down to 8 and push down to 7 and push down into 5. What you are starting to see is what PE is doing is kind of like portfolio arbitrage. So for instance, let's go back to the multiple conversation.
Yep.
If I can buy let's say $3 million business at a 3x multiple, right? As you scale the businesses, you get into higher multiples. So if I can get it up to 9x, I can make a better multiple off the sale. Maybe I'm at 4x now. If I can get it to 10 million plus, maybe I can sell it for 6x. What you get from the private equity side is realization that you have kind of portfolio arbitrage in the sense that I can roll up, I don't know, 10 businesses doing $5 million each top line. And now I have a portfolio that does 50 million. And where I rolled those businesses up, let's say a 3x, I can sell my portfolio now for an 8 to 10x. So you've seen a lot of roll ups in that space. And then you see those probably like middle market private equity firms selling on to big private equity from there because now they're big enough to sell for the big multiple and get their big payout.
And I think that's an area that a lot of people misunderstand of why, because there's a little bit of angst of selling to a private equity firm. Right? You get all these,
Right.
you talk to an owner and they want to sell to somebody local. And the dream is you find some young entrepreneur that wants to be in the exact same business and walk in your shoes, and you're going to sell to them and you're going to be able to mentor them. And they're going to magically have all the cash to buy your business, and you're going to retire, sail off into the sunset,
Right.
and they're going to run this business forever. And the reality is that person doesn't have the portfolio arbitrage area or benefit that these private equity firms have because they're not going to roll up 5 to 10 mats together.
Right.
They're going to only buy this one. So they're stuck with your $150,000 of earnings, and the multiple they're going to pay is probably close to that 1 to 3 multiple. Private equity comes in and says, we can buy this business tomorrow, show up with cash, buy it, immediately roll it into this portfolio. Now it's safer because we have, instead of one location, we have 50 locations.
Right.
So we can handle the cash flow needs. They're well funded. So there's even more stability, going back to our whole concept of they have operators in place.
Yes.
They have a cash management system. They have a process that's already built, and they can come in and offer you the top of the range. They can offer you 3
Yes.
in cash without the headache, but you don't get the feel good feeling.
Right.
I sold to the local kid in town who's looking to buy the business.
The next me.
Exactly.
Right.
Yeah.
Yes.
And those are hard to disentangle. And we're starting to see that more and more where private equity firms are popping up left and right, for different funds are popping up left and right.
Right.
And they're getting smaller to where they're targeting smaller and smaller businesses to do this because the $10 to $20 million businesses already have private equity shops after them.
Yeah.
And so what do you tell the business owner that's trying to figure out, do I sell it one times to the kid down the street who's grown up always and used to sweep the floors in the business and now wants to own it?
Yeah.
Or I could sell tomorrow to a private equity shop that can buy it for 3.
I mean, That's a hard question, and I think it's dependent on the owner today, right? And like what their feelings are. I think it'd be hard pressed to talk to a client and say, "Hey, you should sell your business for 2x instead of 4x because you have the feel good factor, right?"
Yeah.
Because at the end of the day, the retirement funds are the retirement funds that you get from the cash out. I can tell you, in South Carolina, what I tend to see in here is that most of the private equity shops that we see are in, New York, Chicago, Boston, like up north.
Yeah.
And the push is, hey, I've set up this business in, I don't know, 1980 in South Carolina. And I've run it for the last 40 years. It's been my baby, right? I've missed birthdays for it. I've missed, little league like games or something else like that. My kids don't want to run it. I want to sell it off, but I don't want it to go to somebody sitting in New York. Basically, I want the value extraction from Columbia, South Carolina, all the way up to New York City.
Yeah.
Which is it's a big issue to think about, right? You could say the same thing with casinos, and we could talk about that at length as well, because
Yeah.
North Carolina, you have casinos now. But it comes down to the waiting game and what they're willing to take. So, okay, private equity in New York is offering, let's say, 4x, right? I don't want to sell to them today, but I need to find a buyer. I can go get a broker, business broker to try and help me list the business and sell it. Maybe that's a 1 to 2 year process if I can find somebody, but I'm probably going to give up a little bit more. Probably not going to get the 4x, maybe I get 2x,
Yeah.
just hypothetically. It's whether or not they want to play the waiting game of getting out today as opposed to 2 years from now, along with the discount and valuation they're probably going to take. And I mean, situationally dependent from the person that owns the business. Do I want to hand my baby over to that private equity firm, or do I want to wait, take less money, and hand it over to like that feel good situation? Like I found another me, and I'm giving them the opportunity to run what I
Yeah.
created. Yeah,
And one of the ones that the comments that always comes back on that conversation is, well, and I know we're looking at the seller side, right, but the buyer, these are the exact same conversations, right?
right.
If you're trying to buy the businesses, this is what's going through the
Yes,
seller's mind of you trying to make a pitch that sounds better than the New York PE firm who's
right,
about to offer the business that you're wanting to buy, right,
right.
twice as much as that you're able to offer.
Yeah,
And the one area that comes up regular that I think would be kind of the pitch to the buyer, so to speak, of if you're trying to make a good sales pitch of why that person, the founder, should sell to you as opposed to PE, always comes back to like the employees, right? Employees and
right,
customers. What they don't want is if I own a business and I'm about to sell it, my worst nightmare is that I sell this business and everyone in town hates me because I just sold to somebody who went and got rid of all my employees, treat my customers horribly,
right,
right? All those relationships I built out over 40, 50 years since the 80s of building the business is now one day they're gone, right? And that is something I think gets discounted when buyers are looking for businesses. Independent buyers are looking for business of how important that factor is in all of this. Because the business has been successful, the odds of that business being needed for the classic retirement goal
right.
is not there, right? The
Yeah,
value has already been extracted in
right,
cash flow. If it truly is around retirement time, that's not what's going on.
right.
So while it seems like a big cut to go, and it is from a nominal value,
It
a
is.
big cut,
Yes,
right? There's a lot of value there of not having the risk of that business disappearing or just being sold for parts
right.
in that type of scenario. And that's one area where I'm a little concerned now that's getting even broader with all the AI conversation because you're starting to see the private equity firms, and I say private equity, it could be any type of bigger
Equity.
buyer who has scale and is looking at it and saying, I could take that business and I could replace a lot of the processes and people of that business with AI.
Right.
And that's going to be my path to increase margin. And then I'm going to go sell it at
Yeah.
not only a higher multiple, but a higher multiple on a higher margin.
Yes.
So that's a massive pitch right
Right.
there. I mean, if I could take the laundromat and somehow automate this with AI or some of the processes, and I could go from earning 150,000 to 300,000, not only am I earning twice as much, but my multiple is already going to be twice as much once I roll it up.
Yeah.
There's a big pot of gold at the end of that rainbow,
There
right?
is.
For you to shoot for if
Right.
you're one of these. So it's not a surprise that we're seeing so many of these funds being opened up,
Yeah.
especially as more and more people retire. How do you see the AI revolution here affecting both both the talent side and more specifically that operator side, where if I'm having to come in and hire an operator to run this, what are you looking for now?
Right.
Or where do you see the talent
I'd say like
perspective?
on just buying the business, right? If I am me and I want to come buy your business, right? That's the start of the conversation. How are you beating out PE to get there? It's the standard everyday tests that we all do. Maybe we know we do it, maybe we don't know we do it, but it's, would I get a beer with this person? Like that's the basic test. It goes to whether you want to be friends with them, whether you would want to work with them on a day in, day out basis, where you hire to work in the firm. You kind of have the same test when it comes to buying the business. Would I get a beer with this person? It's like that's the basic litmus test. If you can be likable to the point that you and the seller could go sit down over a beer and just discuss business, you're off to a great start. From there, and actually buying the business and the talent flow and what AI is bringing to bear today, it's much different. So it depends on the business itself, like a laundromat and putting AI into one laundromat.
That's a hard example. That's a hard sell.
That's a hard one.
We should have started with a better example at the beginning to build.
Yeah. So from a more, let's say a more labor intensive business than a laundromat,
Yeah.
right? Where you have front office labor that's doing, let's say manufacturing, and they're on the floor in manufacturing. And then there's back office labor that's doing like the accounting, the compliance, the administrative work and stuff like that. So I think of AI like I talk about it in the classroom and talent distribution. And I've given you the example and I'll give it to you again. So I think about labor and talent in the normal distribution curve, right? That normal distribution where the mean is right down the center, and you have the right tail, which is the positive outliers, and in the left tail, that's the negative outliers. I think AI cuts that talent distribution in half. If you're in the left tail of talent, right, you can probably easily be replaced by AI. And what I'm talking about is doing the basic work. Hey, I need to download bank statements, make sure they're put into our system, and then they go over to QuickBooks. I can generate an AI agent today that would do that for me and read my bank statement as it goes into QuickBooks. And maybe I can also generate an agent that replaces QuickBooks for me because that's possible today. So now I've reduced the workflow for that person going and manually getting statements. Maybe they're active for 1, maybe 2 weeks out of the month because they're really in the accounting phase. And then I can also start to replace the person that's dealing with the reconciliation and matching out where my funds have gone. AI is, I hate to be a doom and gloom person, but I think AI is coming for those basic jobs. What you have though over the top is if that's first order thinking, right? Doing those basic redundant tasks, AI can take over that first order thinking. Now your team needs to be able to do like second and third order thinking on top of what AI can do. I think you do have room for talent still to be there and to work on the problems that AI can't solve yet, or get a more critical or creative answer than what AI would give you. Because I mean, we've all used AI at this point. The answers it gives you are pretty textbook, basic. You have to prompt it and know to prompt it to get what you really are looking for out of it. I think if that person already has that inherently, they've got the critical thinking, they've got the creativeness about them, and they have some experience in the space, they don't need to prompt AI. They know what's coming next. So like you can leave your token usage at home and just work with the employee at that point.
Yeah. One of the things you brought up, and I think this kind of relates to this concept of, especially with the QuickBooks and the labor costs. If someone's buying a business, they're looking at these types of scenarios and they're trying to run their own pro forma statements, trying to figure out, if I were to buy this, then this is what the new income statement's going to look like. This is what the new P&L is going to look like with my expertise or with my changes for AI and all of this. Where do you see, because you have a lot of experience on the financial statement side of things and digging into those books, where are the bodies buried when it comes to financial statements? Because you mentioned seller discretionary expenses, and this is one that is brutal when you're looking at buying
It is.
smaller businesses. I use small lightly. I mean, it's like I think even up to the 10 to $20 million business, depending on
Right.
what the margin looks like there, seller discretionary expenses can be quite a number that gets thrown around. And what does that look when you're looking at one of these, but you're looking at business listings and everything else? Where are the areas that you say, I'm going to immediately look here for the red flags? And we'll call it the one that we just said, the salary for the owner. And it
Right.
always comes up as, it's like, oh, well, my business makes, $150,000. Like, well, how much did you pay yourself last year?
Yeah.
Like,
Right.
nothing.
Yeah.
And it's like, well, then you didn't make $150,000.
Right.
You made zero. Right. You personally made 150, but the business made zero last year. Right. What are the other things? What are the ones you look for, those red flags, where even if somebody started to look and starts looking at listings, gets into an
Yeah.
NDA, starts looking through some financials, that you say, look here, and this is where you're going to see some issues.
Yeah. So again, situationally dependent by the business.
Yeah, of course. Let's go manufacturing, something kind of more traditional of
Yeah.
a mix of
Okay.
labor, technology, everything else.
So if I didn't know what I know, I would go out and prompt AI and say, okay, found this business is in manufacturing. First question would be in a manufacturing business that does, let's say it's, I don't know, furniture manufacturing, right? What is the typical profit margin on furniture manufacturing? My guess is it's like 5 to 10%. It's not that high,
Yep.
right? Now that I have that piece of knowledge, I'm gonna look at the business listing and say, okay, maybe they're doing top line 10 million and they say they're doing 4 million in bottom line. That's a red flag immediately, right? Where are they coming from on the 4 million when I think it's supposed to be around, what did I say? 5 to 10%, so
Yeah.
500 to a million, right? In that case, you do have to sign the NDA to get the financials. You get like the basic stuff that I gave you right now. But when you get the financials, they usually give you the income statement and then they'll probably give you the math to back into from EBITDA what seller discretionary earnings are or what they got to EBITDA and any add backs the owner put back into the business to say, okay, it says we're at 500,000, but I added back another 500,000. So we're really at a million in seller discretionary earnings. That is the big trigger. Like if you see a massive amount of ad backs, that's a big one. I'll give you a funny scenario. When I worked in banking, right, we had a accountant move into internal audit with us, and he happened to do taxes on the side. And one of the tax situations he came across that we laughed about for a good while was somebody, the business owner, construction business, added back $35,000, if I'm not mistaken, like in the 20 teens for a boat motor. Hey, I need this to come out. This is a business expense. It's like, this is a $35,000 boat motor. It's like, well, I take the clients out on the boat. So it's definitely a business expense kind of thing.
Of
So,
course.
so, but like you get that kind of stuff that if you don't know, right, you don't know that it should have been taken out of the business. Or if there, maybe it is a legitimate expense and the boat motor needs to replace every 5 years and they don't, tell you it needs to be replaced every 5 years. Another thing, if you're in the manufacturing space, would be maintenance on the machines, right? Machines need maintenance consistently, just like
Yep.
your car or truck, right? A lot of what you'll see in those spaces, or at least I've seen doing this with students in class and pulling out those financial statements and seeing what they're adding back and not adding back. Deferred maintenance. Usually they'll defer maintenance, but not tell you that there's deferred maintenance on the machine. So, hey, the machines need a, I don't know, $250,000 rebuild every year. That's an expense we have. Maybe I didn't do it this last year, so it didn't go into my trailing 12 months of financials. You buy my business, you're going to have $500,000 of expenses now for machine maintenance. And oh, yeah, maybe one of the machines breaks a month after you bought the business. I've actually had business owners in my classroom talking about the business they bought. And that was one of the situations. Bought a business, all the trucks went down a month later. And it was a landscaping business. So, I mean, what every one of the business owners I've talked to, had in my classroom to talk about this, will say is you will never know 100% of what that seller knows about their own business. You're walking into it kind of blind. You get a little bit of information here and there. You do your due diligence. But if they're truly hiding something from you, you won't find out until after the fact, or maybe you don't find all the skeletons in the closet.
Yeah. And that's always the hard part for me when I'm looking at businesses or talking to business owners is sometimes it's treated as it's malicious, like they didn't tell me
Right.
that this there. And a lot of times it's not the case. It's just they've owned the business for so long
Right.
that it's just normal. It's just assumed that it's known, or they didn't think about that as being something that needed to be disclosed.
Right.
So it's almost like buying a house, right? You buy a house,
That's
like,
exactly
no
what I was
matter
thinking about.
what's disclosed, there's always going to be something that wasn't disclosed or wasn't there or breaks after you buy it, those types of scenarios. And that's just part of it. The business aspect, those can be a lot more expensive
Yes.
to fix
Absolutely.
really fast.
Absolutely. One of the items that actually pops up in buying businesses, that is, you've got to figure out as a buyer, who are the important labor assets.
Yeah.
This one comes up quite a bit when we talk to business owners. It's like, okay, I'm going to go buy this business. Part of my diligence process is who is the important talent to keep in the organization. And you try and keep them around either with incentives to stick around or maybe like a contract to lock them up.
And it can't be the owner.
And
Yeah.
it can't be the owner.
Right? I mean, that's a huge problem, right? The
Yes.
founder-led or owner-led businesses, right? That's a huge risk for a buyer.
Absolutely. I mean, there was one owner came and talked to my class. The business owner the original founder of the business had passed away as a manufacturing company, and the wife had been running it for like 7-ish years from an hour away, right? Only came in once a week. What he found out in the diligence process is 2 of the employees were the sales team, and they basically took over. Like, if we didn't take over the business, we wouldn't, none of us in this shop would have jobs anymore. So they took over the business and we're like kind of running it as the sales team. Okay, I need those 2 people to stick around just to keep the baseline of what the
Yeah.
business is that I'm buying, and I can grow it from there or like redo processes and stuff like that. But his identification was, I know the widow is not running the business. Who is actually running this business? And that, part of the diligence process.
How do you keep those people? Are you going in equity? Are you going in bonus structures? What do you think would be the go-to if you were in that? And obviously, that, of course, it depends on the type of business and
Right.
all of these factors, because that is a major, sure, because the people on the team also start to get nervous.
Right.
And if the owner who's always run everything is no longer there, new owner comes in, that's a great time to be looking for another job. Is it time to
Absolutely.
retire? And you see the retirement factor come out all the time. It's like, well, you know,
Yes.
now that Johnny's gone, he's always run the business, treated me well. I think it's time. I'm just going to retire.
Exactly. I tend to be in the incentive disincentive camp, right? From econ majors at
Yeah,
Florida State that we talked to. So I like the incentive structure. Percent of equity, if you can do it, right? If it's an LLC, you're going to complicate your your membership
yeah,
side of it. But profit sharing is super simple, and it should align them to what your best interests are. If you're gonna, I would say, profit sharing with those employees and probably with the talent pool as a base anyway, as a way to, one, get them aligned to your side, and then two, take the growth to another trajectory. So like basically they feel like they own the business and want to do well. There's an excellent podcast. Oh my gosh, I'm going to butcher this one. It's Let's Buy a Business by Ryan Condi, I think is the podcaster.
mhm,
There's one episode. I always put it in my interesting reads on blackboards for all of my classes. It's like an hour and a half long episode. It's about a guy who bought the business that he worked for at like 52 years old. And the way he got all of the employees on his side was he gave them all part of the profits. And he said basically it got to the point where, as the CEO, he didn't have to run the company anymore. The
yeah,
employees did. Like, I think he said he was walking around in the shop, like manufacturing shop, I think it was aerospace, and he found a $50,000 check on top of a toolbox. It was a business check. And he was like, "Hey, what is this?" And the guy said, "Sir, don't worry about that. This is a deal we shouldn't have done. We're already taking care of it ourselves." Basically, like, this didn't go into our bonus pool and it never should have been done as an employee base. We've got it handled. So I think when I think of owning businesses and like buying into businesses and keeping the talent on my side, right, to get in the boat and row in the same direction as
yeah,
me, incentivizing them like that where they feel like they own the boat.
yeah. Especially coming in fresh, right? There's no
Right.
goodwill that you've built up over time to
Exactly.
know that they're going to be taken care of.
Exactly. I mean, there's the Louisiana case. It's very recent. An owner is like a longtime family. Do you know this one? I'm going to butcher it because I don't know the details.
I'm not sure if it's the one that is more recent.
It's more recent in the last 6 months.
Yes,
It's
yeah,
like the Louisiana. It's like
I
food
know.
or
Yes, yeah, yeah. They sold and everything went out to
yes,
the employees of the business.
yeah. So the basic facts of it are: it's like a Louisiana manufacturing company or maybe a food company, been family owned for, I don't know, like 50 plus years. And the current generation decided to finally sell the business. And part of the deal, they had a $10 to $20 million payout to all the employees,
Yep.
where the employees got cut checks of like 150 to $350,000. I mean, life altering money for them in Louisiana. And like that's part of, hey, how do we keep people on our side or reward them for doing the things that
Yeah.
help us get to this point?
So what's funny about that, when I saw that story, my worry was there's another case that was always taught in physical, and this one I know none of the details to, other than there was a similar case where somebody bought the business. The owner had paid out all the employees
For
in
this
this,
one.
and then they all quit,
Right.
right? Because they all retired. So that was the case that I thought when I saw the Louisiana scenario.
Yeah.
Is like, ooh, the risk is you write this big of a check to all of the employees. How worried was the buyer?
Right.
Right, coming in and saying, "Wait a minute, you're doing the opposite of what we
Yeah.
just talked about from an incentive structure. You're just gonna go give all of our employees a bunch of money
Right.
and hope that that money isn't enough for them to say, 'Well, now I'm gonna go do something else.'" Right,
Yeah.
so it makes perfect sense from the seller perspective, but it's a good example of that, that difference of of what the goals are from an incentive perspective,
Right.
because the buyer's trying to incentivize everyone to stay. The seller's trying to incentivize, like, I want to make sure you get a ton of value for selling
Right.
from that point.
No, I had the same exact thought, but I mean, it's an opportunity, right? If you're the buyer, okay, these people, if they're going to
Absolutely.
retire, this maybe clears the way for me
Yep.
to take over and maybe do some efficiencies with AI and or
Ooh, that'd be smooth if that was because that's where you get the buyouts,
yes,
right? A big restructure. We're seeing this now with a lot of the tech companies.
yes,
If you want to leave, great.
yeah,
We'll let you leave. We'll pay you 3 months. Please leave.
absolutely.
And
So you have that, or if you have if you know you're going to have like a brain drain, like for
yep,
let's say, right? Hey, I'll give you a little bit extra in your retirement fund. Just stick around for me for 6 months to a year,
yep,
right? Contribute on top of that, and then you can go. So you're going to get the reduction in labor force maybe that you're looking for as the new buyer, but you get the opportunity to get the information out of them before they take off. It just
yep,
depends on whether where that employee falls on the talent curve for you.
yeah.
Yeah.
Super interesting. I think I could talk incentive structures all day long to try to figure out how that all works and every different piece to it. But I think anyone looking to buy the business, hopefully this gives a little bit more insight into all these different dynamics that go beyond what's the multiple
Yes.
and how do I use it in ways to leverage AI in that process.
Absolutely. So everybody wants to fixate on price on buying a business, but deal structure matters quite a bit. And getting creative, if I could say anything, everything I've learned from the people that I've talked to and been in my classes, deal structure matters and get creative. So get creative, get creative, get creative, and get creative in finding a business to buy. If you're seeing it on the internet, everybody else is seeing it. Maybe you're the guy that's pedaling around, I don't know, Columbia, South Carolina on a bike that's on a bike with a shirt that says, I want to buy your business and here's my phone number. Right. I've heard that on a podcast. Somebody did that out of Harvard from the My First Million podcast. Her name is Sarah Moore. That's what she did to buy a business. So
Yeah.
interesting.
It's getting harder. Competition's getting out there to buy them.
But there's opportunity.
Yep.
There's always opportunity.
Perfect. Well, thank you so much, Brandon. Thanks for coming on.
Yeah. Thanks for having me. It's been great.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.